Thank you, Kyle. Our next session is the good, the bad, and the ugly, the current landscape of private credit. Our next speaker brings a disciplined, global perspective to investing, one shaped by decades of experience across public markets, private capital, and complex, evolving economic cycles. Mr. Paul Lisiak founded Metropolitan Partners Group in 2008 and serves as its managing partner and chief investment officer. Paul focuses on identifying long-term investment opportunities across global markets with an emphasis on fundamental research, risk management, and capital preservation. His work reflects a deep understanding of how macroeconomic forces, policy decisions, and market structure interact and how to navigate them thoughtfully. Throughout his career, Paul's built a reputation for rigorous analysis, independent thinking, and a steady approach in volatile environments. He's known for looking beyond short-term noise to focus on durable value creation, aligning strategy with patience and precision. At a time when uncertainty is the norm and conviction is hard won, Paul's insights into global markets and investment discipline are especially timely. At the conclusion of Paul's commentary, Don Semino, President and Director of Alternative Investments for Waterloo Capital, will handle the Q&A session. We're pleased to have Paul join us today. Please welcome Mr. Paul Lisiak of Metropolitan Partners Group to Ascend with Waterloo Capital.
Thank you so much, John. I appreciate the opportunity to speak to you today. Overall, private credit really has earned its place in client portfolios over the last 10, 15 years, but that market environment is definitely changing. Today is about helping advisors distinguish between the structural opportunities available and cyclical excess. There's good, bad, and ugly in private credit today, and understanding what to look for in private credit managers is more important than ever, as we do expect a different environment prospectively than we've had in the past. Just a little bit about myself here. I founded Metropolitan back in 2008, and basically I've been implementing this strategy since then. Basically, we are looking for under market opportunities where we can find alpha as opposed to betting on cyclical beta. We've been through multiple levels of real stress since 2008, and we basically been delivering low double-digit net of fee returns on a senior secured basis to our LPs. We're managing about $1.7 billion today with 43 employees. That ratio is based on a very high labor and complexity that comes to our investment strategy as we're looking for market opportunities and investments that are below the radar screen of other CUSIP managers or on-the-run private credit strategies. We basically believe we have an all-weather strategy that basically puts downside risk as the premium of what we're looking to minimize, and then yet still enjoy great positive upside by finding, again, under-levered companies that deserve capital in this market today. Overall, basically, we're looking here at private credit, really solving genuine problems that do exist in the world today. Sorry about this. There we go. And we're basically seeing a tremendous amount of capital flows that do come into the private credit markets today as a result. We do anticipate there being a lot more money that comes into private credit today, and institutional capital has basically validated this asset class over the last 2 decades. But with the rapid growth comes actually a need for advisors to truly double click and understand actually what is happening in private credit, as again, not all private credit is created equal. Over the last 15 years here, we've had a real debanking of America. This has been a structural tailwind, which basically has really assisted in driving returns in the asset class. We're basically looking at not only capital flowing in, but where exactly is it flowing, and where is the true need? In the market today, you have upper middle market, and then obviously the lower middle market where Metropolitan operates. But basically, there are 3 very distinct sub-asset classes within private credit, and that basically is something which we need to stop and really look at as we consider where to put our money in private credit today. The big have been getting bigger. There's been rapid flows into the largest of all the managers. You've seen probably a number of headlines recently from Blue Owl to Ares to other BDCs that do have heavily concentrated portfolios in the middle market and higher. And that the top 10 private debt funds are basically taking more than half the capital that's raised in 2024. While that's great for those GPs, they have very much been asset gathering and focusing on enterprise value creation of those general partnerships, while they also consolidate smaller managers and really drive for value to the GP and potentially just offering a portal to market beta for LPs and underlying clients. Basically, the lower middle market has pretty much been left behind here. A lot of people that previously operated in the lower middle market have gone up market as their firms have scaled in AUM. And while those firms scale in AUM, they basically also have been basically driving more capital into the traffic jam that does exist in the middle market, which basically today continues to have lots of liquidity. Framing the lower middle market today, there are basically a tremendous number of opportunities that do exist. About a third of all GDP in the United States comes from privately owned businesses in the U.S. Predominantly, these are all non-sponsored owner-operated businesses that do not yet have easy access to capital, nor have actually already been optimized by private equity. And that leaves a real good opportunity for people that can operate in the lower middle market, where there basically are lots of inefficiencies, both structural in terms of lack of capital that's available to these businesses, but then also for businesses that basically truly have catalytic and fundamental opportunities to take advantage of some of the macro tailwinds that do exist in the United States today. From a what's bad going on right now today, we really do need to actually look at the demand for loans out there in the market today, and basically look at both the returns that are actually available to middle market companies by private credit managers, but also really understanding what and how they underwrite from a risk standpoint. Covenant light has been predominantly the name of the story, name of the game, over the last 10 years. And a lot of private credit managers have been basically backing private equity-backed businesses, trusting those sponsors to drive returns. Now, the biggest challenge that exists there is that they are anticipating for the markets to bail them out relative to either additional private equity and or private credit dollars. So any cracks that actually do occur in these businesses as they basically try to implement against crosswinds in the economy do result in a lot of challenged portfolio companies that have yet to actually see the light of day, relative to defaults and payment defaults and losses for private credit managers. So we are quite concerned with a number of subsectors and sectors that we do see in the middle market, which could create new opportunities for distressed investors and or more nimble investors. However, today we basically do start to see those initial cracks as you see Wall Street Journal headlines in and around certain private credit managers and underlying companies that they've all backed. So what to really watch out for as a manager looking to allocate? We really have a lot of real world problems out there, and basically we do want to see. Sorry, one second. There we go. We do want to see basically what we want to follow here in the coming months and quarters and years. As Kyle actually mentioned earlier before, rapid evolution of artificial intelligence, which basically has led to a lot of job losses and the K economy. Again, as Kyle covered, I won't go into that more, but that is something that we are all watching very carefully today. And there are also many winners that do come out of that, not just flowing money into data center build-outs and other high beta cyclical opportunities where there's a lot of capital, but also looking for how are smaller businesses able to adapt and utilize AI to take advantage of opportunities that actually come from streamlining and lower labor costs. And we're exploring a number of subsectors and niches today that do that. We all also are very still worried about the covenant light aspect of middle market. That is something which, again, you need to be very careful as you're looking to select your manager and look at how they are managing risks when the bull case does not come through. Again, as we're seeing recently, a lot of bull cases are starting to break. Again, as I mentioned before, there's been a lot of consolidation of capital flows into the core and middle markets. And with a lot more money flowing in, the supply demand basically is starting to basically tilt further against middle market credit managers as they compete to put their capital to work. And with more money being raised in their funds, that just continues to exacerbate the cycle. There's been a large rise of asset-based finance in the last few years, people recognizing that asset protection and intrinsic value potentially are more predictable and offer better downside protection than loaning to enterprise value. again, most private credit firms that are doing sponsor-based lending are basically looking at situations where they are hoping and anticipating the enterprise value to stay stable or improve, but that basically comes with more volatility from a beta standpoint, both via midterm rates, but then also relative to a company's ability to operate within their sector. And then finally, over the last 15 years, there's been nothing but tailwinds for a lot of private credit firms. And basically, we believe that there are a number of larger GPs as well as individuals underwriting at those GPs that have never really gone through a cycle. And a lot of those managers are ill-equipped to handle what actually is coming through their portfolio or is actually existing in their portfolio today relative to triaging problems in their portfolio and then working out those portfolio companies. So looking at credit managers that actually have the ability to manage risk when risk occurs is something which is actually harder to look at a track record of recent, as they either don't deal with it or they outsource their work to third parties. Apologies. There we go. So what to look for in a private credit manager? Not all private credit is the same, and basically really looking to try to differentiate and find true alpha versus those managers that are able to catch a very great tailwind in private beta over the last few years. And finally, how are your interests aligned with your GP? Again, while most GPs right now are underwriting loans at or below their hurdle rates, they're really playing the management fee game, and they're really actually turning almost into mutual funds relative to accessing market beta that's available in private credit. So are they working for you in incentive fees as you make money off of your LP investment, or are they basically looking to effectively just continue to asset gather to the benefit of their now either public GP and or basically looking to drive value for their GP as the overall private credit market continues to consolidate amongst GPs? So what are those attributes and traits? Well, proprietary sourcing, everyone does claim to have proprietary sources, and people define those differently, but really look for people that have sustainable relationships and are less reliant upon auction processes. Again, the downside protection from covenant packages, looking to find people that actually can underwrite true KPI metrics and basically have an early warning trigger for problems that come in their portfolio, as opposed to waiting for a payment default after a 3 to 5 year loan. And then again, how do you manage the downside of troubled companies? Just because a company breaches covenants does not always mean that they are basically no longer credit worthy. So being able to differentiate between true problems in a portfolio and just temporary issues that need additional partnership to work through those problems. And then also any private credit manager that has, again, the ability to look at more than just spreadsheets. How do they access operating experience? How do they actually operate sector? How do they access sector experience? And how do they actually look to bring a lot more into their loans, as opposed to just trusting either third-party auditors and or basically accountants or other experts, which are kind of they're renting. And that really also just drives, again, the need for expertise in the subsectors and the sectors which they do invest. You don't need to try to top tick and pick the best next company in private credit, as you have basically fixed upside in most situations. But how do you actually manage to make sure you are in the right part of that sector, in the right part of the cyclical trends that do occur outside of macro trends? So I've touched before basically on sponsor-backed businesses versus owner-operator businesses. And these are two very different markets. Again, most all capital that does exist in private credit actually does exist at the sponsor level, whereby private credit firms are levering up private equity firms in order to drive returns for the private equity LPs and to optimize basically their ability to pay the highest price for companies through leverage. These are often professional management teams, which may have some warrants and options and things like that in the business, but basically they're hired to drive value as opposed to having true skin in the game. Many of these businesses were built during boom times, and again are basically built and are trying to grow to get to the next incremental investor on the private equity side, becoming a public company or M&A. And so there's sometimes less of a focus on medium to long-term fundamental value creation as opposed just to optimizing short-term capital. On the owner-operator side, basically there are a number of businesses in the United States. We count over 300,000 that do exist in the lower middle market, going up to 3 million as you expand that range a little bit further. And all of these businesses are built by individuals who have the supermajority of their net worth in the business. They may not be as sophisticated from the standpoint of financial acumen relative to being able to access the capital markets, but that doesn't take away from their ability to actually generate true fundamental value where investors can participate. So there's actually really an arbitrage that's available for businesses, for lenders that operate in the lower middle market, targeting owner-operator businesses to basically come in and provide a capital solution for those companies that is not going to be competitive against 15 other different investment firms that are trying to also provide capital. But the other big difference there is also the use of proceeds. So on the sponsor side, basically they're obviously levering up and the money is leaving the system. Owner-operator businesses basically often have growth opportunities and or other catalytic events which can be financed. So the capital that goes into the business is creating new value as opposed to refinancing the old balance sheet. So we'll continue to see, we believe, sponsor-backed businesses struggle in the near term. There basically are a lot of data points out there today relative to private equity firms, kicking the can down the road with their private lending firms and basically look for time to solve their problems. Time is actually not the friend of the lender; it is the friend of the private equity firm. So as middle market private credit firms continue to kick the can down the road, we do expect to see a lot more challenges that will actually come through the market, both for private equity firms that give up on their portfolio companies, but then also looking at those private credit firms that are now ill-equipped to handle the problems in their businesses. And net, we don't really believe sponsored lenders are actually getting paid for the risks that they're taking on board. Spreads continue to contract in that market as capital flows arrive. So basically, in addition to risk going up today, we also believe that the reward is going down. Kyle mentioned before about SaaS companies and others that are being challenged by AI. We do believe that exists across a number of other subsectors, whereby there are opportunities for more nimble, smaller businesses to take advantage of low-cost tools to help build up their businesses. So back to where we think private equity is going today as well. As you look at basically this data from Adam Street, the actual ability for private equity firms to actually accept the failures of some of their portfolio companies continues to go down over the last 5 to 7 years. And so we believe there's actually a large pent-up tsunami of failing or underperforming businesses that will come through private equity portfolios here in the next couple of years. And so, typically speaking, 10 to 15, up to 20% of private equity deals do result in some level of capital loss for a private equity firm. And that number basically has been realized to be very low percentage points over the last few years. So we believe that there's a lot of pain to come through the private equity portfolios, which will create opportunities for asset divestitures, distressed investors, and or cheaper M&A, and or outright failures of these businesses that will just go away in the coming quarters here. But again, back to excess leverage, basically why this has been able to continue to perpetuate and why the losses haven't been realized is that there's just excess leverage in the system. And that excess leverage allows mediocre businesses to continue to access capital. They don't really see any marginal revenue productivity of that new debt coming into their businesses. And relative to how PE shops are actually raising the capital with EBITDA add backs and other tricks, it does allow people to feel comfortable on the way in. But then as add backs basically unwind, as the business has to actually now generate actual real cash to cover that cash interest, that basically will result in, again, ongoing struggles and stress, which will become more and more apparent here in the coming quarters and years. So, back to Metropolitan here, what we do, we try to avoid that traffic jam that does exist in the core middle market. We do look to find non-sponsored businesses that are actually going through some type of fundamental catalytic event. They need capital to create value. They don't need capital to pay off old sins. And this is really what's been attractive for us over the last 16 years as we continue to implement our strategy and partner with strong companies that basically are looking to achieve that next level of success. And then Metropolitan's returns are sharing in that. Unlike core middle market that's getting, say, SOFR 4 or 500, our current underwritten returns on a fixed income basis approach 18%, while we also get warrant kickers in a lot of the underlying situations as well. And people do always ask us, well, these must be pretty distressed companies or desperate companies to partner with Metropolitan and accept that cost of capital. But the secret is really trying to find businesses that are looking for their first institutional partner. They're not optimizing for cost of capital. They have a higher return on our capital than actually the cost. And that is a positive flywheel effect that allows us to actually partner with companies and manage very successful growth. So with that, I'll pass it back over to Don.
Cool. So for all the audience members that are on the call, we have a Q&A button in your video screen. You can submit questions to Paul, which we'll discuss. Just to start it off, Paul, we've worked together for almost a decade, and over that time, we've seen a tremendous growth in the private equity asset class. I know that that's likely to continue. At the same time, we've seen the high yield credit market shrink and shift to private loans. How do you distinguish between healthy growth of the asset class versus that is masking a decline in underwriting standards or mispricing of risk?
Yeah, I mean, I think the overall asset class itself basically is a bit of a slave to the capital flows that have been coming in. Obviously, as a GP, if you are raising capital from your LPs, they are expecting you to put that money to work. And you have no control necessarily over the market by which you're putting it into. You could have portfolio selection. You're obviously looking at certain credits. You're looking at certain counterparties. But at the same time, if you have capital to invest, investors are trained to put that money to work in the strategy by which they raise the money. So we really think that the true differentiator coming up here is actually to try to find places and opportunities and assets which do not see those capital flows, which will allow a better risk-adjusted return, for both the LPs and the underlying, so the GPs and the underlying LPs.
We've seen the majority of the capital coming into the space, going to the largest managers, the largest deal. They often bypass the middle market. Why do you think the lower middle market and the middle market more broadly remains structurally underserved? And why is that an opportunity rather than a risk in your view?
Yeah, so I mean, again, the capital flows are coming into the middle market, which we define as businesses greater than 100 million of revenue per year. It's really the economics of actually managing an asset management firm, which makes it harder to underwrite in the lower middle market, where it's the same, if not more work, to underwrite companies that are underbanked, who do not have a private equity sponsor. And so as a GP, if someone hands you a few $1 billion more, you don't go try to find more deals in the lower middle market. You actually go up market and try to look for easier transactions to underwrite, which, albeit at lower cost of capital, basically there's still better economics for that GP to go up and just basically provide cheaper loans with less covenants in order to win deals. And that's a phenomenon that we believe has been happening for at least 10 years, possibly 15, which basically has created some misalignment of interest, I think, between some of the GPs and LPs at these larger shops. I think also the rise of enterprise value that actually now does exist in some of these medium to large scale asset managers, again, does start to create more of a mutualization of the asset class, where again, they are portal to market beta. So if you actually do believe in the market beta in the core middle market or upper markets, that's a very easy asset class to access. There's other managers now providing interval funds and obviously the BDCs, and now the publicly available, Apollo, KKR, Blue Owl, all these businesses are now over 80% private credit. Apollo and KKR started off as private equity managers working for incentive fees, and now they're asset gatherers looking for management fees as they structure complex projects and products for LPs to access on a click of a button.
So you kind of talked about some of the larger managers that are operating in the BDC space. We've seen a lot of volatility last year in public BDCs and a real divergence in private market.
Yeah, I mean, I think, 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 I Sorry, Don, you're breaking up there.
Let's see. Can you hear me, Paul?
I can hear you now.
Okay. I was asking about volatility that we've seen in the public BDC space. So last year we saw a lot of drawdowns, specifically centered on a few individual managers, whereas in the private credit space, and we're probably talking more about larger, more syndicated transactions, but do you see, with the growing disparity in pricing in public and private BDCs, do you see any sort of systematic risk being built into the valuation, especially in the larger, more syndicated deals?
Yeah, I mean, I think that one of the challenges a lot of larger institutional allocators are facing today is that they put capital across 6, 7, 8 different private credit managers, and then when there's a large default and potential loss in an underlying credit, they're seeing it show up in 3, 4, 5 of their credit funds. So while they thought they were diversified across multiple managers, the persistence of club deals and syndicated loans as basically actually more concentrated risk for them. So we think that will continue again relative to the debanking of America. A lot of these deals need to be put through the syndicated market, and obviously the easiest capital to access today are those larger managers who need to put the money to work. You do see hyperscale deals in hyperscalers. Blue Owl announced a $2 billion loan transaction to a data center build out. And whether or not that's a good deal or not, I can't opine to it. But just looking at the size of that transaction and how much money needs to go into that, obviously they're going to need to access co-investors on a syndicated basis or look to go out to their LPs. But the standardization that does exist in those syndicated deals does result in things like First Brands that was obviously very, very public. Everyone was trusting the investment bank had done the underwriting, and because there's so many other lenders in the deal, it must be a good deal. All these people can't be wrong. And again, in an up market with lots of beta tailwinds, it's a quick place to put your money to work. But obviously, as the tide goes out and people realize that no one really did the work, you basically have double pledged assets, you have an over-levered business, and you actually have, again, now that they're coming out with all these details, appearance of pretty systemic fraud. And so there's not a comfort in numbers when it comes to lending. It's really the opposite way around. What can you trust? What assets can you verify? What is my true downside protection? And basically, if the business case goes sideways, how am I going to get back out? The joke that I learned when I was at Lazard doing high yield credit coming out of school was basically fixed income is all, high yield debt, fixed income is all the upside of fixed income, all the downside of private equity. And so you just can't have the convexity of that trade go against you when you basically realize that there are no assets and or basically the business is effectively not worthy of the credit that it's taken on board.
Same sort of vein. If many GPs are ill-equipped for rising defaults and non, what are some of the early warning signs allocators should be watching for to suggest that maybe managing rather than actively managing the credit risk?
So look, so the statement of being ill-equipped comes down to the fact that a lot of these larger managers are trusting third parties, and those third parties are obviously PE shops and auditors, and again, those are high quality individuals. Don't get me wrong, but they're on the opposite side of the trade. Auditors are getting fee for service, and the PE shops basically are obviously looking to sell you the best looking company that they possibly can show. Obviously, when companies go sideways, someone needs to step in and actually do a turnaround or asset recovery. And larger shops notably outsource that to the likes of Alvarez and Marsal, Alex Partners, other turnaround shops, which again are high quality individuals, but they're an agent in that transaction. So truly, basically, they're getting fee for service, and then if they deliver you back 40 cents, 60 cents, or 80 cents on the dollar, that's possibly reputation based, but at the same time, they say, like, we didn't underwrite the deal, we're doing the best we can to hand you your money back. And so again, they're in there for the fees as opposed to basically trying to get back 100 cents on the dollar. We believe that self-underwriting, self-asset management, and self-workouts basically is what's required in the private markets. These are incredibly complex businesses, and while they get dressed up nicely by private equity firms, what's going on under the covers basically does require certain skill to unpack and understand what are the true KPIs that are key performance indicators that are driving value. What are the key performance indicators that will potentially be a radar screen for future challenges in the business? And then how do you monitor those on a very tight basis and actually look to see truly what's driving asset value, business performance, and enterprise value, again, as opposed to trusting an annual audit. So we at Metropolitan basically have typically 30 to 50 loan covenants per loan. We're monitoring those on a monthly basis. So within 3 to 4 weeks of a month end, we're getting reporting from a company across those KPIs, and then we're re-underwriting the company each month to ensure that we're not seeing falter of the underlying company or the original underwriting strategy. And then if there are problems, to step in with different levels of intervention to try to help that business basically get through potentially any short-term challenges. Businesses will encounter short-term, medium-term challenges all the time. It's not does it exist, it's just to what extent. And basically knowing the art of actually what are problems and actually what are opportunities is really what differentiates, I believe, our strategy from traditional private credit, which again is relying upon the governance of the private equity shop to tell them if there's a problem. So we actually go in and do our own homework and eat our own cooking.
Shift over to Metropolitan and your strategy, which is really based on asset-based lending, collateral-based lending. We saw collateral-based lending kind of shift from the banking sector post-Dodd-Frank. At this stage, we're roughly over a decade past that. Do you see asset-based finance as a cyclical response to changes in regulation, or a permanent structural shift how the economy gets financed now and moving forward?
Yeah, I mean, there's been a lot of discussion about asset-backed and asset-based lending over the last few years. I mean, I think the attraction for limited partners is that assets themselves can be intrinsically valuable counterparties. You obviously potentially have some rate risk in certain types of assets. You have some sector trends in some certain types of assets, but there really is an intrinsic value, to that, from real estate to PP&E to even certain other working capital assets that exist in a business. You actually do have the ability to look at those as discrete counterparties and to value those independent from the enterprise value, which is created through the combination of all those assets. And so I think that there is a strong feeling that basically you can trust that, and you can measure it in faster and better ways than a business itself. There's a lot of on the run ABF and ABL out there. Think auto loans, think lending club paper, et cetera, and those get well packaged up and put into neat products with lots of layers of fees, and it could be very attractive for certain risk reward profiles. While they're pooled into large assets that are tranched. But we take the overall approach of actually going and looking at accessing those assets on a direct basis through proprietary sourcing and not having multiple layers of structuring fees and or other banking fees that are attached to it. Over 80% of our loans over the last 15 years have been sourced without the use of a banker or broker, whereby we're actually directly finding the companies, directly finding the assets to finance. And that basically inures to the benefit of our LPs as the company, the underlying borrower cost of capital is fully ingested by our loan structure, as opposed to us only getting a portion of that value with other value going out to third parties at closing.
Which broke down what to look for in a private equity or credit manager. And in so one or two due diligence questions, an advisor allocator should ask. What would they be to avoid, some of the issues that you kind of outlined in your presentation?
Yeah, I think the bookends of private credit in general, but it's more acute to the lower middle market. Really does come down to proprietary sourcing, and really comes down to your ability to manage risk when the companies don't go right. anybody can underwrite a deal and let it work and plug and dust, great. If you can find those, that's awesome. But basically, through proprietary sourcing, if you can minimize risk and optimize upside relative to actually being almost more a relationship-based, lender or relationship-based partner. Sometimes that comes from long-standing relationships. Sometimes that comes from differentiating yourself on the way in and trying to find a borrower that's trying to optimize for something other than pure cost of capital. And again, we think with so much capital flowing into private credit, a lot of private credit selection by borrowers actually comes down to the cheapest with the least covenants, which means the lowest return and the highest risk for the private credit firm and the underlying LPs of that private credit firm, who are winning the deals solely based on basically being the cheapest provider. So that's the first bookend. And then again, the second bookend, how do you find a private credit manager that's been through cycles, either macro or actually even underlying sector cycles? They've had to deal with problems in their portfolio, and judge them on those businesses and how they're able to recover value for LPs, as opposed to basically just saying, oh, yeah, we messed up this deal, we lost X%, and we're moving on to the next one. Sorry, guys. So I think those are the two primary things that actually advisors should really be looking at in selecting a manager. Johnny, you still there?
We appreciate it. Great. With but again, Paul, thank you again for your time.
Thanks so much. Really appreciate it.